GKFX Prime presents the Market Analysis Webinar.
Hello everybody, welcome to another edition of the weekly webinar. Welcome back to those of you who are becoming regular viewers. To anybody who's new, we hold these webinars on a weekly basis, basically with the aim of covering some of the most popular markets out there to trade. We typically focus on the Forex market. We also look at commodities, namely gold and oil. We also look at the cryptocurrency market with Bitcoin, and also stock indices with the S&P 500. If there are any other markets you would like us to cover, please drop a comment in the video. We'd be more than happy to hear from you, or any other feedback you have. Drop a comment, and of course, if you get some benefit from the video, please click that like button too. Without further ado, let me get right into these charts here. And so I'm excited to say that we are finally seeing a breakout in the euro-dollar currency pair. We've been in this tedious range between 108 and 110, which, with the benefit of hindsight, did offer plenty of trading opportunities. Buy at the bottom of the range, buy at the bottom of the range, sell at the top of the range. But finally we've had that upside breakout, which is what we were talking about being a possibility for last week. We'd mentioned that this EU recovery fund was creating some optimism in markets, and we were looking at these previous peaks as a place that was stalling out the price, and maybe this midpoint of the range as being the jump off point for a breakout. And we had 1150 on the chart from last time because it's the round number near this previous peak, and we've just touched that as of today. So all looking quite rosy for the euro. It's certainly a possibility that we're now in just a more expanded trading range. So if we jump out to our daily chart, what we may just be dealing with is the tighter range from down here has now become a bigger range. So we're now dealing with more like 108 to 1150 rather than 108 to 110. But to me, we're above our moving averages. We had a breakout from a fairly well-defined range. We do need to take out this 111.50, and then we have the hurdle of 112 above. But I remain quite optimistic on this market. It feels to me like we've turned into we've shifted to a more positive gear. The kind of trading strategies I would advocate would be more trend following at this point rather than the range-based trading strategies using oversold and overbought in oscillators and things like that, which have been working over the past 6 weeks or so. To me, seems more like a moving averages, trend-based strategy period as we continue this upside action. Now, of course, got to watch 111.50. You know, if the price collapses back from here, we have to kind of reconsider our options. But I'm looking for an upside break, 111.50 and then 112, and I suspect we can eventually move to this 114 level. The EU recovery fund is far from being approved. It has a lot of hurdles to jump through, so it's quite possible the political noise knocks us back through these levels again. We also have the ECB meeting this week, and so of course that's very important for the euro and could determine how long this breakout lasts. Now let's have a look at the British pound, and if you remember last week we were also talking about how I was looking at the something akin to a positive a bullish divergence in the indicator versus the price. We said, oh okay, it made a marginally lower low, but actually the general scheme of things seemed to feel more like that actually the momentum was kind of holding the lows, whereas the price was making lower lows, and at some point the price was going to catch up. So we'd broken out of the price range, but the momentum indicators weren't quite doing the same sort of thing, and we were talking about that possibility of the upside break in the euro, and we said that, well, oftentimes the pound moves in the same direction as the euro because obviously they're both trading against the dollar, and so we were basically talking about the idea of the pound holding on to this low, and we were just looking at different risk management techniques for how to trade that. And so this is how I left it, with using this rectangle pattern with 50 pips as a kind of risk management technique. So if you had gone for that more conservative looking for the price to come within 50 pips of the low, well, of course, you're not in a trade right now. Had you been a little bit more aggressive in your entry, and had you taken even 80 would have done it, but if you'd just taken the round number of 100, so 100 points above that low, then obviously you would be in the trade right now. And so that's just an example of how to kind of look at things when you're expecting a potential turn in the price. How do you kind of put that kind of risk to reward together? And so let's just have a quick look at how we would stand at that point. So 120.75-ish was the low. Say our hypothetical entry point was 21.75. So then, of course, you want to be at 123.75 in order to have a 2 to 1 risk to reward ratio, and we've hit 24. So if you were working on a kind of 2 to 1 risk to reward basis, you'd ought to be out of the trade here in a profit in that entirely hypothetical scenario. So again, looking better in the pound now, but obviously it did take out this low, and maybe we're just into a kind of recovery rally before the next drop. If the euro is going to hold on to that 111.5, and this is just a kind of meandering recovery rally, and the pound eventually is heading lower, maybe sub 120, then obviously that's the kind of bearish scenario. At the moment, I'm taking a more positive view, assuming that the pound can trade back up to the top of the trading range. Remember, we've got Brexit talks resuming this week, which presumably will end in a stalemate. There's no real great expectation that something good happens from Brexit talks this week, but the pound is still moving higher nonetheless. So sort of strong price action relative to the news, which tends to be a positive for the price. So let's see how that all bears out. Now let's have a look at the yen. Continuing to be one of the more difficult to trade. So we had the sort of breakout of the downward trend, but the kind of upside has been very slow to materialize. We had that kind of sudden drop through the 20 period moving average. We rallied back up. I believe that was on Friday, and now we're kind of tipping down again, so not quite making it through 108. Obviously if the euro dollar is going to continue to jump, you would imagine that dollar yen probably trades lower, but if it's a function of kind of a risk on risk off market, actually dollar yen should in theory be rising in a kind of risk on scenario. But it's this is a bit of a tricky market to trade. I think one thing I'll be looking for here is basically we had this layer of support through here. Obviously we had the fall, so here were the lows. We tried to break, well, it was a false break, and hence the strength of the rally up. We hit the top of the range. So basically I think if we come back through this previous low, and if we in fact make a lower low through here, then we've made one lower low, a marginally lower high, and then we make another lower low, then we've got the kind of confirmed downtrend, and then I'd be looking for moves back down to those 106 lows. For now it feels rather range bound, and even were we to get below 107, we've still got these kind of layers of support just beneath there. So a bit of one of the more tricky markets to trade, I would argue, at the moment. The most clean thing to happen would be at that breakthrough 108, because there's been substantial resistance through there. This is the kind of shorter term one, but obviously the kind of longer term one is just above 108, but 108.10, and should we get through there, that would be, this potentially is a head and shoulders, or even a cup and saucer kind of pattern here, like a long basing out kind of low, and I think that would set up some decent upside, but we're not there yet. Onto the Aussie, one of the best performers. This is the daily chart, up through that 67 level, which I have to say, I did not think would happen this quickly. But I have been saying in these webinars to stay positive with the trend in this rebound, and we had, as we've looked at lots of times, this spike low. which did hold up the price for a little while. And then if you drop into our 4-hour chart, this is what we had last week. And I said, you know, bit of a false breakout, but such a positive trend, not really looking to trade lower on that. And actually we just held on to the 65 level, and we had this little declining trend line, which, if we can look at the date of when that was, the 25th. The 25th was the Monday. So we were obviously in the midst of some sort of break of this downsloping trend line last Monday, and actually, you know, that's dropped down to the prior resistance aside. You know, it's obviously proved a nice little trend line break, worked out quite nicely, and then subsequently we had this resistance through here, which just broke in the last few hours. So short-term and long-term positive picture for the Aussie dollar. Let's just watch out for the 67 level, because that is big. It basically denoted this previous high over here, and it was the, if I zoom out a little bit, it was these lows through here. So when we had been edging down, we had that flash crash, and then we edged down to 67, and you know, we basically had that kind of false break to the top side here, started accelerating, stalled at the 67, and then really started to crash. Got the little rally up to 67 again, and then really fell off a cliff. So quite a good psychological level here, this 0.67. The news over the from Friday is that Trump did remove Hong Kong's special status, which is bad for Hong Kong, but he didn't really escalate the US-China trade war, and so that's good for China-sensitive assets like the Aussie dollar. So still looking good for the Aussie fundamentally, but we're just watching this 67, a false breakthrough there. That to me would be potentially a longer-term bearish signal to unwind some of this huge rally it's had. Okay, moving on to gold. So this was quite nice last week. It was a good example of a trend line break in a moving average, in a technical indicator, so this time the RSI, and so we'd drawn this trend line in, we'd highlighted the fact that it had broken lower, and at the time it hadn't broken, the price had not done its own equivalent break. Actually, this worked as I indicated it could do, with the price eventually breaking lower, and so it worked out pretty clean. You know, the bigger picture is that we're in a rising market for gold, so you don't want to be some kind of heavy seller. So, but we did get that rising trend line break, and it took us down nicely to 1700, where we got the close. We had a little whipsaw below it, and then subsequently we've broken another rising trend line, a declining trend line, and rallied back up to that 1740, which is kind of this this ceiling price through here. So 1740, potentially an area where the price rolls over again. But as I say, I wouldn't really want to be taking that trade because it's kind of counter trend. Depends on how you would read the current situation. I can see that it's quite a good level, and it seems like at the moment we basically had that false breakthrough 1740, which is basically this, right? Sort of rallied up, fell through, couldn't get through it again, dropped. Now we're back at it again. So it will be a positive if we can get that, if we can push through 1740. To me, it indicates new 7-year highs shortly afterwards. It would suggest that we're going to take out these highs once we've held above 1740. But if we don't, maybe just after some confirmation, we've had it on an intraday basis at the moment with this the attempted breakthrough and then the close back below. If this gathers some momentum and close the day lower, then start thinking about 1740 as maybe a level that the price doesn't move back beyond in the short term, for a potential again another kind of short in the in what is a range at the moment, but it's just got an upward bias to it. So you know, you're okay doing shorts. I would still argue they're a bit high risk in this environment. So that's it for now on gold. So we've taken out 35 on our spot WTI contract. This is our 4-hour chart. So big rally, obviously, consolidation, and we've broken through the top side. So this is a breakout signal, a bullish signal. You know, we haven't really done much since the break, which is not really necessarily what you want to see. It's giving you time to get into the trade, but it suggests to me that we probably drift lower again. The price action it's again one of those where it's been actually quite positive in the face of the news. I mean, the more broader outlook is that we're kind of positive about the economic reopening globally, and hence the stock market's pushing higher, which we'll see in just a minute. But as far as oil markets, it is yeah, we actually saw rising US inventories again, so that that is actually a bit of a kind of bearish factor in terms of oil supplies, but nonetheless we're pushing up through that key 35 level, so that's good stuff. Well, let's have a look at the cryptocurrency market. So actually, if you remember, I'd basically pointed to this trend line break. It depends how you want to be drawing it. You can kind of draw it through more like the middle of these lows, etc., etc. There are different ways of drawing it. So I think via one method we basically held it. Oh no, not quite. But yeah, depending on how you draw this, I mean, the most straightforward one through the actual kind of lower points, so missing this one, but drawing through this one, we broke it, which is breaking of a trend line doesn't always mean the trend immediately goes in that direction. It's like a first indication the trend could be reversing. So we had a little edge lower, and now we've actually moved up into, again, an example of where it's a kind of lower, I don't want to say lower risk, but a better risk to reward situation, rather than trying to sell on the trend line breakdown here after the price has already dropped. You wait for the push back up to within a kind of reasonable distance from the previous peaks, and start to look for the market to roll over again here. Now obviously at this point the market is looking a lot more positive than it was down there, so then you suddenly start thinking, do I really want to be selling this? To me, this looks like a market, we're obviously grappling with 10,000 in Bitcoin here, right? So that's the bigger picture. If we look at the daily chart, you know, we tried to get through 10k, had that big collapse in March, rallied all the way up before the halving. We've stalled out since the halving, and we're looking for that big breakout or the collapse from 10,000. Of course, we don't know which way it is, but I'm saying there's a potential risk-reward situation here to try and back the latter. So potentially we're running into those old highs. It might be a situation in which you again have the chance to sell from a higher position, not sell at the weakness, sell into the strength. So just purely from an ability to sell at a higher price point, it's interesting right now. But obviously we are in a kind of more bullish phase in the short term. If we're looking at a 4-hour chart, we're still basically rising prices, but we had the trend line break, and we've got this risk reward situation. To me, all bets are off if we're above 10,000. That's our kind of bullish key for higher prices. Of course, we could get another false break through 10,000, but I think that's the line in the sand that everyone's watching. So from here onwards, I guess the price could nudge higher into this range, but just watch this area as another potential sell-off point. And last but not least, the S&P 500, which let me put it on the daily chart, because all the chat last week, and including by my team, I have to say, was the move through the 3,000 level and the move beyond the 200-day moving average, which is this blue line through here. So we obviously moved above it. We have come down and tested it. As of Friday, we closed up near the highs, and so at the moment, on balance, still positive. You know, we had the breakout of the range, break above 3,000, move above the 200-day of the retest. So all looking good for now. But just bear in mind, if we get a daily close back under 3,000, and particularly not even just 3,000, that's the round number obviously, but this 2975, call it, which was the kind of how I was judging this trading range here, that to me would basically call this a false breakout and usher in a much weaker period for the market. So a little bit more make or break here with this 3,000 level. Everything at the moment looks good, and we're not overbought yet in the market, so there's still room to move to the top side. And if we do, I'd imagine the 3,150 or this previous peak, as we had pointed out before, will be the natural target. News flow generally pretty good. Trade tensions not knocking the market yet. Of course, there could be some big escalation there around the corner. Maybe some actions taken by China, but it sort of feels like neither the US nor China, they would neither want to shoot themselves in the foot economically, when obviously we're going through a bit of a tough patch with the pandemic. So that's obviously the logic the market's holding. Let's see if it actually holds true. So for the time being, getting the rallies off the 3,000 level, we're in a kind of little pullback zone now. So we're basically trading on the basis that we've had the breakout of the range, it's held, we're moving to the top side. That's what we're looking for. Right, thank you very much everyone for attending. Really appreciate it. Good luck with trading this week, and of course if you enjoy these videos, tell your friends, tell your colleagues, and subscribe to the channel, and you'll make sure you don't miss when we release the same one next week. Thank you everyone.